and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. Global stocks extending their declines then after President Trump's tariffs triggered Wall Street's worst day in 5 years. The US president, though, says he is not worried, adding he's open to tariff negotiations.
Well, it depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff?
OK, let's bring in Brendan Murray then, who leads our global trade coverage. And it's a reminder, Brendan, isn't it, that this was not a clearing event on Wednesday from the Rose Garden, that negotiations are possible and that the rhetoric and the language we're getting from different members of this administration, from the president himself, continues to change and that uncertainty remains. Do we have a period of negotiation between now and April the 9th?
Well, yeah, the clock is ticking on these tariffs. They kick in on Saturday night at midnight and then again next week. The president says, yes, we're open to negotiations, but the question is, who wants to talk to him now? We've heard the Europeans say we should rethink our U.S. investments. The Canadian foreign minister was on Bloomberg TV recently saying, we're talking with partners in Europe and Asia. So the question is, did the announcement of these tariffs spark these trading partners to come to the table, or is there going to be a period of rethinking whether we can really trust that process with the new Trump administration? I mean, the calculations have stunned many economists as well in terms of how they actually came up with these tariffs, and there have been some adjustments to some players. But between now and April the 9th, what are you watching for? And then post-April the 9th, I mean, are we expecting further sectoral tariffs as well? Or is the market pushback to this are we seeing any reporting to suggest that there is any kind of rethink at all, given what we've seen in terms of the rout of these global markets? The president himself has said the pharmaceutical tariffs are coming, the chips tariffs are coming. He talked about critical minerals in the ceremony in the Rose Garden the other day. Those apparently are going to be subject to investigations, the normal process by which you establish presidential authority to impose those sectoral tariffs. But as far as we can tell, they're happening, and by his framing, they're coming soon. So you could expect a series of these in the weeks ahead. OK,
Brendan, thank you very much indeed for always keeping us up to speed on how the tariff deliberations continue, of course, to be adjusted in Washington. Brendan Murray, who leads our global trade coverage. Traders are now fully pricing in, by the way, 100 basis points of cuts from the Fed this year after recession fears and market volatility wiped, as we've mentioned, $2.5 trillion from the S&P 500, and that looks set to build in the session today, with futures sharply lower as well stateside. For more, let's bring in Bloomberg's Valerie Teitel. So, Valerie, we had the equity market reaction. The downside continues. But the sell-off as well in terms of, or I should say, the money moving in, the bond rally today is pronounced.
Yeah, that's right, Tom, especially in European fixed income. There seems to be a risk-off move building here in Europe, and the dollar is reversing stronger on the day, I might add. But I took a look at how yesterday's slump in the stock market compares to historical slumps of the 21st century. And, Tom, I mean, just take a look at this. A 4.8 slide in the S&P 500 yesterday. I mean, comparable to the worst of the dot-com bubble. We saw a slide of 5.8%. Comparable to the slump after the September 11th attacks of 4.9%. Not so comparable to the worst days of the GFC, even the U.S. downgrade, and the worst day of the COVID era. Down 12% was the worst one-day slump for the S&P 500 there. But it was a bruising day for not only the equity market, but also the dollar. The dollar yesterday wiped out all of those post-election gains, was on a back foot. And this is a key narrative here, Tom, going forward, because previously in big risk-off scenarios, the dollar normally rallies. Yesterday it didn't, and many people still scratching their heads on whether that move is sustained. If we move on to my next element, we can talk a little bit about the non-farm payrolls print, which is, hey, the big data print of today. The weekend is not here yet. We have the non-farm payrolls print to contend with. The headline number is expected at 140K. The unemployment rate is expected expected to hold steady at 4.1%. But not only do we get this data, Tom, we also get Powell speaking around 4:25 London time. Just what does he make of the recent jitters in the market? Does he sound more pessimistic on the U.S. economy moving forward? We should note, though, that the pricing of Fed cuts since Powell last spoke, which was only a few weeks ago, has increased. We're now looking at 4 rate cuts from the Federal Reserve this year. That's what the market is pricing in, 100 basis points of cuts, which is a substantial move to when he spoke last time when it was just around 2.
Yeah, 3 cuts now fully priced for the ECB as well as those market adjustments continue. Bloomberg's Valerie Teitel, thank you for breaking it down for us. President Trump then has dismissed concerns the tariffs will lead to a slowdown.
I think it's going very well. The markets are going to boom, the stock is going to boom, the country is going to boom, and the rest of the world wants to see, is there any way they can make a deal? They've taken advantage of us for many, many years. For many years, we've been at the wrong side of the ball, and I'll tell you what, I think it's going to be unbelievable.
OK, let's bring in Laura Cooper, head of macro credit and global investment strategist at Nuveen. Laura, good morning. Thanks for coming into the studio. Ed Yardini says buy the dip. Bill Gross says you risk catching a falling knife. Where do you stand? How much further downside is there? Or this is potentially an opportunity to add exposure to some of these names?
Well, I think risk sentiment is going to be guided really by the tariffs. It's going to be guided by labor market resilience. And it's going to be guided by central bank policy reaction functions in the near term. And then I think there's kind of the long-term considerations around corporate earnings, with U.S. bank earnings kicking off next week. We also have to consider capital flows if we're going to see this further rotation from the U.S. And I think that begs the question about how much of this ongoing uncertainty will continue to feed into the confidence channel. So I think this is going to be continued choppy markets with risk sentiment still on the back foot because of the ongoing lack of clarity around what the end game is in this current market backdrop.
Is this a new world order that investors need to be thinking about now?
I think looking at the price action yesterday, given the fact that the dollar came under pressure at the same time that we had this risk-off sentiment, does raise questions around, is this a structural shift that investors need to consider, a rotation away from those typical safe haven assets in the U.S.? And then kind of adding to that, if we continue to see this dollar weakness, that is going to be inflationary in and of itself. That's going to aggravate the tariff implications from the growth perspective. So are we having to consider a new regime? Perhaps. And I think it's going to be crucial to watch some of these key indicators in the coming weeks.
The market's pulling forward their bets, ramping up their bets on cuts from the central banks. 75 basis points from the ECB, about that number from the BOE, and 100 basis points from the Fed just this year from those 3 central banks. Is this a market that is starting to expect and bet that central banks ride to the rescue?
I think that is certainly what the price action is telling us. I think the key challenge is, if we look at the economic data in the U.S., we're going to see some near-term support from the front loading ahead of the tariffs. We have yet to see a material deterioration in that labor market data, even though it's going to come in the next coming months. And then overlay that with the inflation risk tilted to the upside. This is not a Fed that is going to be in a hurry to cut rates this year. I think the growth impulse on the downside is probably going to be more pronounced next year, and that could lead to a steeper cutting cycle in 2026. But markets may be getting ahead of themselves in terms of 2025, and we'll be watching for Powell's comments later today to see whether he pushes back on some of this market pricing.
So that's really interesting. So you think the market pricing right now, 100 basis points this year, that's premature, but maybe the cuts come next year?
Only because there's this ongoing degree of uncertainty around what the inflationary impulse could actually turn out to be. There's questions around what could the retaliatory impacts come through on tariffs. Could we see negotiations? What are the growth spillovers? There's so much uncertainty. I think the Fed is going to take an extended pause. We really need to see a significant deterioration in financial conditions for them to pivot against a backdrop where the economic data so far continues to show that resilience.
What is your base case then in terms of U.S. recession? We were speaking to Saxo Bank and their strategist early on the show. They said now their base case is mild recession in the U.S.
So as it stands right now, if we incorporate the tariffs to date that are announced, and if we assume that those are persistent, then that tilts our U.S. growth picture this year to about 0.5 percentage point. That's a material revision from our earlier forecast of 2%. But we're not yet anticipating a recession recession as our base case. Key to watch, though, will be the retaliatory measures coming through from key trading partners, and as well what we see in terms of the growth impacts from some of the cutbacks that we are seeing in the labor market in the U.S. We're starting to see the layoff indicators suggest that we are going to see greater deterioration going forward, and I think that's going to be a crucial gauge to watch.
Is the picture slightly clearer for Europe? We have some details around the fiscal spend from Germany on infrastructure and defence. We have the tariff number now, 20%. How do those two factors play against each other? And what does that do to your view around European equities?
I think it's this environment where investors globally are dealing with heightened uncertainty and greater volatility. And so, yes, we have the policy stimulus impulse in Europe, but it's hard to have that when we have this kind of broader risk sentiment being an underpin for European equities. I think at this point, valuations will come back into focus and continue to drive some of those rotation away from U.S. equities. But we really need to see some greater clarity in terms of what could the retaliatory measures be from Europe? What could the central bank reaction function be from the ECB? You know, they're in this backdrop as well, where inflationary pressures are probably going to the opposite side of what we're seeing in the U.S. because it's going to have this deflationary impulse. So a lot of uncertainty yet. It's really about looking at up-end quality exposures, becoming more defensive, and maybe looking at Europe over the medium to long term.
So quality, maybe some defensives to add in there. What do you do with fixed income and credit? What is your advice to investors right now when they're thinking about exposure to those asset classes?
Well, I think what's been interesting about the credit market is we're seeing kind of this coupling of decompression, dispersion, and as well as defensiveness. And so to our mind, we're probably tilting more into the rates backdrop just because of the growth risk. So extending some duration in pockets like UK gilts, for example, and I think staying away from some of
You would lean into the buy that's happening right now, the back end of the gilt curve. You think that's rational, and you would lean into that?
Because it adds this uncertainty adds conviction that we are going to see greater growth pressures, particularly in the UK. I think elsewhere in the rate space, in the US, we struggle to see much more material downside for US yields with the 10-year already below 4%. Because yes, we are seeing this bid on the back of rising recession pressures. But again, this inflationary expectation, I think, has to feed into that as well. We've already seen near-term inflation expectations start to be priced materially higher. Investors will have to grapple this kind of balance between growth and inflation risks. And so I think at 4% is probably what we're seeing from a range-bound trade going forward until, again, we see more clarity on what could this tariff outcome actually be.
Briefly, before we let you go, given all of the adjustments and the pressures within the credit markets had not been pricing in a severe impact of tariffs, certainly not pricing in a recession. That adjustment is now happening. Potential black swan events when it comes to the credit markets in riskier parts of that market. I mean, how far away do you want to be from that in this scenario?
I think if you want to stay kind of invested in credit, then it's taking that up-end quality bias, and as well as looking at those key sectors that are going to be less exposed to the tariff backdrop. So the U.S., banks still screen cheap. We like pharmaceuticals, kind of utilities. Those that are, providing a little bit more of those defensive properties. But again, it's looking at kind of looking at the signal through the noise, right, and trying to gauge, if we don't see a U.S. recession materialize, then perhaps there are going to be buying opportunities, given the widening we've seen in spreads and the still all-attractive all-in yields.
Okay, Laura Cooper, thank you very much indeed. The US benchmark 10-year currently yielding 3.94, yields down 8 basis points. And Laura Cooper not seeing much further downside in terms of yields when it comes to that part of the yield curve, but maybe some opportunities in high-quality credit. Laura Cooper, head of macro credit and global investment strategist at Nuveen. Coming up, the US tries to reassure NATO allies in Europe, but stands firm on defence spending demands. We have the latest from Brussels next. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Tom Mackenzie in London. France's President Emmanuel Macron is urging European companies to stop investing in the US in response to Trump's tariffs.
What's important is that we pause future investments or those announced in recent weeks until we've clarified things with the United States. Otherwise, what message would we send if we have major European players investing billions of euros in the American economy at a time when they are hitting us? So we need collective solidarity.
The tariffs, of course, a major talking point at the NATO foreign ministers meeting in Brussels. Bloomberg's Oliver Crook is there for us. So Europe and Canada, Ollie, pushing for a strong response when it comes to that tariff response and retaliation. What is that shaping up to be? How much cut-through is that message getting at this NATO meeting?
Tom, you know, it's not officially on the agenda here at NATO, but it's an impossible conversation to sort of get around here with the tariffs and all the foreign ministers from NATO countries gathered here, including Marco Rubio, in order to have discussions really primarily about defense. But we've been talking to him a lot about this question of tariffs, and we're starting to hear more and more from a number of different leaders across the world about what the tack they're going to adopt in addressing the Trump administration and retaliating against these tariffs. We heard from the Canadians. They're sort of retaliating. They're sort of matching a lot of these tariffs. We heard from Emmanuel Macron there in France, saying that basically European companies should not be investing in the United States right now. We heard from Robert Habeck, the German economy minister, yesterday, likening the sort of attack of tariffs to the attack of Ukraine by the Russians in terms of the impact that it could have. While the United States is trying to rewrite the global order, that is also going to be rewriting not only its position there, but the position of a number of others. And I just spoke to the Canadian foreign minister, Mélanie Joly. Have a listen to what she said about the approach that she's taking and how it might affect her relationship with the EU.
I think the only strategy the U.S. is putting on the table right now is they want to have strong hands every time they're negotiating with countries, and they want to do bilateral deals. What is clear is the president wants to do a global reset on trade. And it's his vision to do so. I've had conversations with Secretary Rubio about that. And the question is how much political capital is President Trump willing to spend on a recession?
And it's become clear from the U.S. administration that the United States believes that it is the only game in town, and they may in fact be right. They may eventually get everybody to the table. But in the meantime, you are seeing a realignment not just of the United States, but a number of different allies. We have the Canadians here talking about changing their relationship with the Europeans, having a closer relationship there in order to be able to stand up to the United States. Could we be starting to think about, in the sort of area of trade, of a sort of G7-1 kind of arrangement? Those are the conversations we're having between foreign ministers.
And you mentioned, of course, Secretary of State Marco Rubio, who is also on the ground in Brussels and trying to reassure, really, European allies of America's commitment to NATO, which, of course, has been questioned at a time when his own administration is smacking a number of NATO members with double-digit tariffs.
Yeah, Tom, I think you're right to point this out. And there's a question, I think, in the minds of many people, whether it's policymakers or citizens or really anybody, about how much of a distinction there is in Trump's mind between the question of foreign policy, the question of tariffs, the question of defense. To what degree will these each bleed into each other, and to what degree will they each be used as sort of leverage points for the other? As far as what we heard from Marco Rubio yesterday, I have to say that for NATO allies, it was a very reassuring message. I think it's basically what they wanted to hear and what they expected to hear to a certain degree, because he says that basically the United States is fully committed to NATO. Donald Trump will stand behind NATO, but a NATO that reaches basically 5% spend of GDP. That is the number that has been once again reiterated by Marco Rubio, saying, in fact, that the United States itself will reach that 5% target as well at a certain point, and really wants to see that from other allies in Europe. We should say, however, speaking also again to the Canadian foreign minister, saying that basically at the end of the day, Marco Rubio can say whatever he likes, but at the end of the day, the buck stops with the man in the Oval Office, and that might change at any moment. We've seen quite a bit of volatility from Donald Trump, but for the meantime, some reassuring words from Marco Rubio to NATO allies.
OK, Bloomberg's Oliver Crook on the ground for us in Brussels at that NATO summit. Ollie, thank you. Staying on the question of defence, UK defence company Babcock International is investing billions in refurbishments in its naval support bases, anticipating demand for military upgrades as the UK and other European nations ramp up that defence spending. The defence firm, which already employs more than 12,000 people, expects to need 5,500 more over the next decade. This after the government decided to boost defence spending to 2.5% of GDP by 2027, meaning an extra £6.4 billion. I'm joined now by Jamie Nimmo, who has been charting this story for us with the lens on some of these defence contractors and defence companies in the UK. Is this boom times then for UK defence? What are you seeing on the ground?
Yeah, I mean, potentially. That's certainly what they're hoping for. Babcock, especially, the other bigger firms, BAE, have seen their share prices soar this year, 40-50%. Babcock's back in the FTSE 100. They're really hoping, they're investing heavily and they're hiring already in anticipation of this boom. And the smaller companies, there's some 12,000 in the UK, they're really hoping to get a piece of this as well. The difference for them is they don't have the financial firepower to really invest now, and so they are sort of anticipating demand but trying to work out how they can really capitalise on it.
That's 12,000 companies in the defence space in some form in the
Yes,
UK.
in some form. There are a lot of smaller suppliers that do anything from, I mean, we spoke to a company that did tents for the MOD, the Ministry of Defence. There are all sorts of little things where they create plastics, and defence is the main, you know. So,
Jamie, what is the impact then on the UK economy from this?
Well, potentially could be large. I mean, we're talking about a large percentage of spending going into defence. Jobs could therefore increase. I mean, if you look at the overall manufacturing space in the UK, it's been in decline for several years. The car industry especially, we hear about people pulling out, fewer cars being produced here, the costs are high. But in defence, that's been rising, even though defence spending has been falling. So there is demand, and don't forget, they can get contracts from elsewhere in Europe and in the US. So it's a really growing industry, and they're really hoping this can, push them even further.
OK, Jamie, thank you very much indeed. Important reporting in terms of the defence space of the UK, how it's adjusting, hoping, of course, to benefit from the increase in defence spending, 2.5% of GDP by 2027. Now, just checking back on the markets with a particular focus on the FTSE MIB in Italy, falling now 10% from its March peak. That is the benchmark, of course, index over in Italy. Set for correction territory today, under pressure. Banks, Unicredit down 6.8%. Banco BPM down 6.3%. Banco Popular, every single Italian bank, it seems, under significant pressure as markets bet that the ECB will have to do more on rate cuts. Lower rates, bad news for the banks. Recession fears as well globally on these Trump tariffs. Coming up, yesterday's drop in the Bloomberg dollar spot index was the sharpest intraday decline since 2005. We focus on FX next. This is Bloomberg. Good morning, happy Friday. Welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. The global sell-off rumbles on. $2.5 trillion wiped off the S&P in one session. But President Trump says markets will boom. The US president also leaves the door open for tariffs to be negotiated lower if there are, quote, phenomenal offers. Traders now ramping up their bets on more Fed cuts this year as they await the first comments from the Fed chair since the tariffs were announced. The dollar pairing some of its losses in the session today against the euro. Let's get you the pricing on euro dollar then. Your currency, euro dollar, this is over 2 days at 110, moves of 1.4%. You saw a sharp drop, of course, intraday for the dollar yesterday. Overall, the greenback has wiped out all of its gains since Donald Trump won the presidency in November. The Bloomberg dollar index is down about 4% year to date. That's as a new wave of tariffs, of course, upended global markets and arguably the global trading system as well. Yesterday's drop in the Bloomberg dollar spot index, then the sharpest intraday decline, as we mentioned, in data going all the way back to 2005. Let's bring in the analysis then. Meera Chandan, co-head of global FX strategy at JP Morgan. Meera, there's so many places to start with this story. Let's start on the dollar. What happened to the dollar's safe haven status? Because that appears to have crumbled.
Well, the safe haven status, I don't think necessarily it has crumbled. I think we have to understand what actually drove dollar strength in the last couple of years. For the last 2 years, dollar strength was about U.S. exceptionalism, growth in the U.S. outdoing the rest of the world, U.S. equity is doing much better. Of course, on the economic side, the productivity, relative productivity was in a much better state. And what's happening now is that U.S. is finally catching down to the rest of the world. A lot of the underlying dynamics have become more stagflationary-like in the U.S. And in contrast, of course, we've had the U-turn in European fiscal policy, which I think is going to be a big source of support for the coming years for the euro, or at least provide some insulation. So I think...
Is it the end of U.S. exceptionalism?
I think we can agree that cyclically speaking, for the next 2 to 3 quarters, it is definitely a moderation, substantive moderation in U.S. exceptionalism. I think whether this lasts over the course of a year or longer is something we have to stay tuned for. But at the moment, the tariff policy is such that it is resulting in a rethink of the global growth outlook, U.S. included. And what that just means is that people are going to rethink where they hold risk assets, and the world is long of U.S. equities. That's part of what the dollar strength was about for the last couple of years. U.S. equities went up a lot relative to Europe, relative to China, and the dollar was strengthening alongside. So, of course, now if there's a growth scare, that's where the positioning overhang is.
What's the cleanest way to play dollar downside, further dollar downside from here?
So I think it depends on whether you think the U.S. will just moderate and the Fed will cut rates and it'll be fine, or whether you think U.S. is going to head into recession. Our own thinking from our economists is there's a 60% odds now of a recession. But if that's the case, then expect substantially lower yields, central banks to cut everywhere. The currencies that benefit would be Japanese yen to a large extent. Any of the low yielders like the Swiss franc. Usually Asia would benefit, but they're having to deal with tariffs. So I would say the Japanese yen is probably cleaner. But if you're in that other scenario where the Fed cuts rates a bit, the rest of the world cuts rates, maybe President Trump rolls back a bit of the tariff policy, there's a negotiated outcome, then some of these mid-yielders, euro included, euro would be a prime beneficiary of that. So look for substantial gains there.
What does that 60% calculation on recession odds mean for your views around how far the Fed goes, with markets now pricing in 100 basis points this year? Are they getting ahead of their skis?
I think the Fed's going to be in a tough place right now, because even before the tariff announcements this week, our economists were looking for core PCE to be north of 3%, right? And if with tariffs, that's going to be even higher a number. And of course, everything that the administration has said has indicated that their main assumption is the dollar will strengthen, but it's actually weakening, which means it adds to inflationary pressures in the U.S. So it remains to be seen whether the Fed's going to prioritize growth or inflation. Our view is that they will prioritize growth, meaning that the 100 basis points that you mentioned is not out of whack. However, I think regardless of whether they prioritize growth or inflation, it really spells negative for the dollar, because say they're focused on inflation and they don't actually cut as much, and that's a real pain trade for markets. It just means that that the risk asset unwind needs to be to a larger degree, and so the dollar weakens even further.
Well, we can link that back to the yen, of course, with that yield differential then closing. What are you targeting on yen?
So as part of, I would say that if we are ending up towards just what is priced in by markets right now, the target should be closer, the fair value is probably closer to 140 for dollar yen. If we're talking about outright recession with substantially larger rate cuts, then that can, I think, go down to the mid-130s pretty quickly.
Mid-130s. 140 is kind of baseline at the moment in terms of...
I think, what's priced in, the dollar yen should actually already be close to 140.
Okay, we're currently at 146 on the yen. It's just a little softer by 0.2 today, but that's largely, arguably, a function of slightly stronger dollar. But of course, given the gains that we saw for the yen yesterday, what are your other favoured trades for investors looking for shelter?
Yep. Look, euro is a very interesting candidate to me, because there's a few things that are going on in euro. There's, of course, a U-turn on the fiscal policy that I mentioned that gives you a source of support for growth.
To what extent does that offset the 20% tariffs?
Well, I think 10% tariffs is completely offset by the fiscal support, according to our calculations. So we had assumed that if we get a larger amount, say 20% in total, that's an extra 10%, that might elicit a bit of a response in euro dollar. But our view so far has been buy the dips in euro dollar, because the narrative has completely changed. It's the attractiveness of U.S. assets that's in question. And if you take a look at who have been the largest buyers over the last couple of years for U.S. equities, euro is definitely front and center. The Scandi currencies are front and center in that. A lot of Asian currencies as well, and Switzerland. So any of these countries where there's an overhang of U.S. equity longs, they need to now, with the rethink on global growth and U.S. growth, need to bring it back home, or at least adjust that.
So it's a repatriation unwind story.
It's a repatriation or an FX hedge, putting on FX hedge story. But regardless, it leads to substantive strength in the euro.
So your year-end euro dollar target?
We penciled in 114 to 116 provisionally. And I think what we still have to see is, once the increased fiscal spending actually starts hitting the growth numbers, which is going to be a second half story, you're going to have potentially a period of time where Europe could be outgrowing the U.S. And so this is, I think, once in a decade possibility of a turnaround in the euro. So after multiple years of investors talking about U.S. exceptionalism, everybody is not wanting to do that anymore. They're tired of it. And I think that's why the gaps, you can see that euro dollar moves have been pretty gappy to the upside, and that's something that we expect will continue.
Okay, 114 to 116. We're currently at 109, potentially a change that we haven't seen in terms of for the euro in that kind of historical context. The pound is taking a bit of a whack today, down 9 cents. Of course, yields moving dramatically lower right now across the gilt curve. So 13 basis point move lower on the 5-year, 396. The benchmark 10-year at 439. How are you thinking about the pound on stagnant growth in the UK, but ramped up Bank of England cuts, which is at least the market position right now, 75 basis points?
Yeah, absolutely. I think the sterling has benefited a lot from being a high yielder within the DM context. And I think to your point about, all central banks are getting repriced to deliver cuts. So, and obviously the high yielders have the most room to cut. So it's the high yielders that should really be, in a sense, weakening the most. And that's why you're seeing what you're seeing with the dollar. So the view on sterling is the growth prospects on a relative basis look better in the Eurozone. The fiscal room is more, and the willingness to tap it in the Eurozone has changed. It's much better, again, compared to the UK, where fiscal tightening is probably more in the pipeline for us. And it just means that between euro and sterling, euro has more room to outperform. So looking for sterling underperformance here, euro sterling towards 87 or higher is the base case.
Okay, looking for sterling underperformance, 114 to 116, maybe euro dollar 140, with the caveats around the Japanese yen. Meera, thank you very much indeed for coming through with the market analysis on, of course, a wild week for these markets, with FX, of course, front and centre as well. Meera Chandan, co-head of Global FX Strategy at JP Morgan. The European Stock 600 index now down close to 2%, sliding to a January the 15th low. Currently down 1.9% for the European Stock 600 after dropping 2.6% yesterday. The heavy selling continues, with pressure particularly focused on Italy, with drops there. The FTSE MIB down 3.5%. The IBEX over in Spain down more than 3%, and the DAX in Germany down a full 2 percentage points right now, dropping 433 points. The price pressure also on when it comes to the oil space. Oil prices continuing to fall as President Trump's tariffs spur demand fears, and with OPEC Plus making a shock decision to increase output faster than previously announced. For more, I'm joined by Bloomberg's Will Kennedy. Was the market expecting OPEC Plus to be adding barrels at a time of recession risks emanating from the US? How consequential is this for the oil markets?
Yes, they were expecting OPEC to add barrels back into the market. That was OPEC's plan. But what we saw yesterday is they're doing it much faster than expected, 3 times as much oil as was expected. Will come onto the market in May, more than 400,000 barrels a day, and that came as the market was already being hammered by concerns about the economic impact of tariff. And you put that together, and it was a really, really important day in the oil market yesterday, with prices down more than 7%.
It seems very counterintuitive given the tariffs, and the pricing is collapsing again today, down 3% on Brent at 67.98. Is there a floor under? Where is the floor for the oil price right now, and what was part of the calculation for OPEC Plus, given ramped up risks of US recession?
Well, Saudi Arabia, the leading member of OPEC Plus, has taken this decision, we understand, because it had grown increasingly frustrated by the inability of other members in the group to stick to their promises, especially Kazakhstan and Iraq. And I think that policymakers realise that prices would clearly take a hit, but they're willing to do that in the shorter term to try and reimpose some discipline on the group. And of course, the dilemma for a country like Saudi Arabia, which was sticking broadly to its pledges, is that others don't, you lose market share. So it needs to protect its share of the market. So they've taken this decision in the knowledge that, yes, it would hurt prices, but it will allow them to pump more oil to offset some of that, and hopefully will convince other members of the group in their eyes to stick more closely to the agreement.
Okay, reminiscence at least to some extent of the Russia-Saudi price war of COVID era, with the Saudis, of course, going all out, adding more barrels onto the market then. So 3 times more than what the markets had expected. We continue, of course, to monitor the oil markets for you, with prices collapsing again, down 3.5% on Brent, 3.7% on WTI, now below $65 a barrel on WTI. Will Kennedy, thank you very much indeed for the update on the oil markets and OPEC Plus's decision meeting this weekend, of course. The US Commerce Secretary, meanwhile, Howard Lutnick, says importers to the US will have a tough time figuring out how to respond to President Trump's tariffs, but he says the world will quickly adapt to the new trade order. He spoke to Bloomberg's Jonathan Ferro.
Donald Trump is focused on the economic pain that the United States of America has suffered over decades. Since NAFTA, 90,000 factories, not jobs, factories, 5 million high-paying jobs gone overseas. He's focused on the U.S. worker and the U.S. economy. And what's going to happen is people are going to realize it is the great American economy that is the winner here. And anyone who doubts it, and anybody who shorts Donald Trump, or anybody who doubts the strength and the power of the American economy, is making a foolish bet. Sure, importers are going to have a tough time figuring out what to do because they went and found the cheapest production in the world. It's time to bring that production home, to have the smart, amazing people who run American companies figure it out, bring robotics back to America. And I would say that United States domestic growth is going to have the greatest resurgence ever under Donald Trump, and that's what he has set in motion yesterday.
You'll accept it takes time to engineer a supply-side response, though, sir. And in the meantime, you can see bad things happen. Do you accept that?
Well, what I can accept, of course, it takes time to build factories, but companies understand how to do it. They will do it. The United States of America is the greatest economy in the world. People have to do business with it. The rest of the world will bring down their trade barriers, and you'll see a great resurgence in our ability to sell agriculture overseas. You'll see factories being built here, and that factory production will be faster. So, sure, there will be a rebalancing of those who make things in cheap labor markets, figuring out how to make them here. But ultimately speaking, and I think in much less time than you think, the world will reorder itself, will figure it out, and the United States growth rate will turbocharge compared to the rest of the world.
Okay, US Commerce Secretary Howard Lutnick speaking to Bloomberg Surveillance. Meanwhile, Bloomberg has learned that Republicans in the US are considering a new tax bracket for those earning over $1 million to offset some of the costs of their tax bill. The move would be a stark departure from decades of Republican opposition to tax rises. Sources tell us that the new top rate could be around 39 to 40%, bringing it back to where it was under President Obama. It's been reported that the director of the U.S. National Security Agency has been fired. The Washington Post says General Timothy Hoare was dismissed alongside his civilian deputy, Wendy Noble. The move has been criticised by senior Democrats. A South Korean court has removed President Yoon Suk-yeol from office over his declaration of martial law. It paves the way for a presidential election within 60 days, which Yoon will be barred from contesting. Bloomberg's Sherian has more from Seoul.
President Yoon Suk-yeol's impeachment has been upheld by the Constitutional Court just behind me. Right now, these are protesters that wanted the permanent removal of the president. They're cheering, they're celebrating, they're walking now towards Gwanghwamun. Now, a national election has been triggered. That needs to happen within 60 days. The leading contender at this point is the opposition party leader, Lee Jae-myung. Of course, right now the country is still being led by the acting president, Han Duck-soo, who wants to bring a little sense of stability. In the meantime, he's talking to his ministers. He's trying to bring some semblance of stability in a country that has been hit by tariffs from the United States, by economic woes, the Bank of Korea has faced many challenges in trying to support the economy, but now with a little bit more certainty over where the course of national politics goes from here, we'll continue to watch the latest developments as here in Seoul, at least in this side of the Constitutional Court, protesters are cheering the Constitutional Court's decision. Sherry An, Bloomberg, Seoul.
Coming up with less than 24 hours to go, there is not much time left on the clock for a TikTok deal. We get the latest. This is Bloomberg.
Taxes and deregulation were the three-legged stool, and right now the focus is on tariffs.
As things stand now, we're headed to recession. And it's very clear that this is a tax on businesses and households.
The U.S. is known for the innovation and the stuff we create, and I think it's exceedingly burdensome for small companies like ours.
In the next couple of months, the labor market still stays okay.
As the adage goes, if the U.S. is going to have a slowdown, other regions probably are going to be worse.
Some of the voices we have had on Bloomberg Television reacting to Donald Trump's latest tariffs. Now, AI stocks in the US have already lost over $3 trillion in market cap since mid-February, and may see more pain from the wider sell-off. That is the view of Bloomberg Intelligence. Its tech analyst Tamlin Basson joins me now for some of the details. We are seeing some huge falls then, Tamlin. I mean, you have to wonder whether or not some of those tech CEOs regret being up there on the podium during the inauguration of President Trump, or at least whether they wonder if this is what they'd bargained for. What is the catalyst to put a floor under this rout for these tech names? Is there further downside? What are you assessing in terms of just how much bloodletting is going on in this space?
Well, I think you mentioned it. It is AI. AI, we've been talking about this for 3 years now, and so much investment has been gone towards AI, towards building out these data centers, towards developing these LLMs. 2025, we're looking at, investors are starting to wonder where are the returns on all these AI investments. We do expect more of these real-world use cases to roll out in 2025, led, of course, by sort of the agentic AI solutions. I think if these can sort of be an attractive use for companies that are now reeling from these tariffs and are looking to sort of protect margins, if these AI use cases can sort of help them gain efficiencies, then that could be sort of a catalyst that helps people see some near-term benefits from all these AI investments.
Okay, that's interesting. So agentic AI could be the catalyst, but before we get there, we could see US tech targeted. Maybe it has a target on its back. I mean, particularly from Europe. Is that another risk?
Yeah, and I think right now everybody, I think, is waiting to see what the response from the trading partners of the U.S. are. And the EU especially has layers upon layers of regulations on the technology sector that has not been shy about wielding in the past. And I think we definitely may see some new outcomes and cases. There was news today about a potential $1 billion fine against X under this content moderation law, Digital Services Act. I think yesterday under GDPR, a potential fine against TikTok. So I think the EU regulators may very well respond with this, but also we may see this as a negotiating tactic, and later on we see potential benefits for the tech sector, maybe a decrease in the digital services tax, which is something the Trump administration has really pushed for in the past.
Okay, so we watch for that development and to what extent it's part of the calculus of Europe. Meanwhile, to China, I mean, massive tariffs obviously broadly on China, then on Taiwan as well. What does that mean for China and its chip and tech ambitions?
Yeah, so we're talking to our analysts who cover the Chinese tech sector, and they say it is really too early to tell, but the initial feeling is it's not going to be as bad as 2018. And part of the reason why is China has more advanced internal markets where they can shift some of those excess capacity. You have a stronger EV environment, you have a stronger smartphone environment, that maybe that can absorb some of the capacity for the locally designed and built chips. Again, though, really too early to tell what the overall impacts are going to be there.
Okay, Tamlin Basson, thank you very much indeed with the analysis. Bloomberg technology analyst at Bloomberg Intelligence. Well worth reading that analysis as well on the terminal. Now, staying with technology, Intel shares are higher in pre-market trading after the information reported of a tentative deal for a joint venture with TSMC. The report says executives from both companies have agreed that the JV will run Intel's manufacturing plants. This confirms Bloomberg reporting that the idea was being pursued at the request of the Trump administration. Now, the deadline for TikTok to find a buyer or get shut down in the US is less than 24 hours away. Once again, President Trump said yesterday that a deal to sort this out is close, yet significant hurdles remain. Bloomberg's Charlie Wells has been following all this for us. Where do things stand, Charlie?
I mean, Tom, this could just not come at a more tense time, right? Because you had those announcements about tariffs yesterday, you've got this deadline tomorrow, and then you've got Trump trying to kind of weave this all together and use tariffs as leverage in these negotiations. As far as a deal, Bloomberg has learned that the top contender, and there have been a lot of contenders floated so far, the top contender would involve a consortium of Oracle, of Blackstone, and of Andreessen Horowitz. And basically what it would do is kind of spin off TikTok into a kind of independent U.S. company. But one of the sticking points here, and I think this is going to be important potentially down the line, is that the algorithm would stay in-house at TikTok in China. And that's been one of the points that was really at the center of that national security law that was passed about TikTok last year. So that could make this difficult, right? But at the same time, you know, Trump has got to kind of bring together these investors to try to bring a deal that he has promised is close together. He's also got to get China to sign off on this. He's got to get ByteDance to sign off on this. But at the same time as well, Republican lawmakers helped support the passage of that law last year. They do not like what they see in TikTok. There are a lot of Republicans are China hawks. And so the concern here is a deal could take longer than the deadline, which is just a couple hours away, could take longer than that. But then on the home front, Trump starts to see pressure if he keeps extending this deadline longer than a couple of weeks, months, who knows?
Yeah, as you say, there's a number of really tricky issues that they have to iron out before they get a deal. And of course, that deadline is on Saturday. And the key question around the algorithm, but also the cost of this thing as well, the investment will be significant given the value of TikTok US. Charlie Wells, who's been following that story for us and no doubt will be giving us an update on Monday as well, depending on what happens. Charlie, thank you very much indeed. Let's get back to these markets before we wrap the end of this show, because the sell-off continues in Europe after dropping 2.6% yesterday by the end of the close. The pressure continues on European equities as investors continue to adjust to this new global order. You're seeing the benchmark stock 600 now down more than 2%. Over in Spain, the FTSE MIB falling more than close to 4% is the drop over in Italy. The IBEX is off by 3.5%. And the bond rally continues apace. Money moving into gilts, into German bunds. You're seeing moves of 11 basis points on the 5-year here in the UK. Bunds, BTPs and Treasuries all bid. Stay with us. This is Bloomberg.